Welcome back to another Explainer. Today, we're going to build a mental framework that will absolutely transform how you look at market cycles, asset classes, and ultimately your own money. We're moving way beyond basic stock picking here to look at how true wealth is actually built and protected over decades. Let's dive right in.
So, I want to start by asking you a serious question. Is your money truly diversified right now, or is it just kind of scattered? Because honestly, a lot of investors fall into a really dangerous trap. They think that just because they own 20 different stocks, they're somehow magically safe from a market crash. But think about it. If those 20 stocks are all highly correlated, like say they're all tech stocks or all consumer discretionary, well, they're going to plummet at the exact same time when panic hits. There's no real protection there.
Okay, let's look at our roadmap for today. 1. The diversification myth. 2. The 3 wealth buckets. 3. Bucket 1, the cash weapon. 4. Bucket 2, passive income. 5. Bucket 3, capital gains. And finally, 6. Your winning portfolio strategy.
All right, part 1. The diversification myth and why traditional portfolios often fail. There is a massive difference between being scattered and being truly diversified. Being scattered is just owning multiple things that all act exactly the same way. When the market panic hits, they all crash together. Boom. True diversification, on the other hand, means owning distinct asset classes that protect you across completely different economic conditions, what we call the different seasons of the market. You know, the stock market isn't the economy. It looks 6 to 12 months into the future. So if you want to survive the tough winters, you need a structured solution, not just a random handful of ticker symbols.
Moving into part 2, the 3 buckets of wealth. This is your financial foundation.
Now, before we even talk about specific asset classes, I want to give you a mental framework for how to think about your total wealth. Every single dollar you invest should be mentally placed in one of these 3 buckets, and each bucket has a totally different purpose. Bucket 1 is cash, your opportunity fund. Bucket 2 is passive income, where you get paid while you wait. And bucket 3 is capital gains, your high-growth engine. By giving every dollar a defined job, you completely remove the panic when markets get volatile.
And this brilliantly illustrates the whole concept, using a sports team analogy from our source material. Think of your wealth as a championship football team. Bucket 1, your cash, well, that's your lone goalkeeper. Bucket 2, your income assets, like REITs and bonds, those are your defenders. And bucket 3, your growth stocks and ETFs, they're your midfielders and strikers. Look, a team of all strikers might win some games and look super flashy doing it, but they'll eventually lose catastrophically because they have zero defense. You literally need the whole team to win the championship.
Section 3, Bucket 1, the cash weapon, your goalkeeper.
The absolutely most underrated investment strategy in the entire world is simply holding cash during periods of high market optimism and then deploying it aggressively when optimism is low. Just look at the contrast here. During a market summer, when optimism is at 100% and everyone's making easy money, holding cash makes you look kind of foolish, right? Your neighbor is day trading on their lunch break and bragging about it. But during market winter, when optimism plummets below 25% and panic sets in, holding cash makes you look absolutely brilliant. Your cash bucket is not idle money. It's a loaded weapon waiting for the perfect target.
So, the golden rule for Bucket 1 is this. Always maintain at least 20 to 30% of your investment capital in cash or cash equivalents. You hold a bit more in the summer and less in the winter when everything is practically on sale. This is exactly what allows you to act like the smart money when everyone else is just capitulating in fear.
Section 4, Bucket 2, Passive Income. These are your defenders.
The passive income bucket is all about generating regular cash flow, totally regardless of whether the broader stock market is rising or falling. We're talking about assets like high-dividend stocks, real estate investment trusts or REITs, and government or corporate bonds. Think of it just like rental income. Even if the property value temporarily dips, you are still collecting that rent every single month. This bucket provides reliable income that you can live on, reinvest, or, crucially, use to buy even more assets during a severe market correction.
So, the crucial point for this bucket is a robust target annual yield of about 5 to 10%. You're not looking for wild, thrilling growth here, not at all. You are looking for extreme reliability. You want companies with a 10-plus year history of consistent dividends without any cuts. These guys are your anchor in the storm.
Next up, Section 5, Bucket 3, capital gains, your midfielders and strikers.
The capital gains bucket is your high-growth engine, and it's designed specifically for massive price appreciation over time. This is where your long-term wealth is actually built. So what goes in here? Well, undervalued sleeping giants, high-growth sector ETFs, and broad index funds. You're basically hunting for companies the market has temporarily mispriced, maybe due to panic or just neglect, and you patiently hold them through the cycles until the market wakes up and reprices them correctly.
But wait, how do you actually find those sleeping giants without getting tricked by a terrible company? You use the ultimate lie detector test, the cash flow statement. See, companies can manipulate their income statement with all sorts of clever accounting tricks, but you simply cannot fake cash. Cash either moved into the bank account or it didn't. End of story. To find a true giant, you pull their cash flow statement and look straight at the operating cash flow. If it's negative, but they're reporting profits, you walk away. The operating cash flow must be strictly positive and consistently growing. That right there is the foundation of a real business.
Now, what's really interesting about this slide is the target. Because you are taking on more risk and volatility with these growth assets, your target compound annual growth rate, or CAGR, needs to be massive, 10 to 20% or more. Getting there requires immense patience. You have to ride out the market's crazy volatility through different economic cycles to actually see these kinds of returns.
Finally, Section 6, your winning portfolio strategy. Let's put this all together. I want you to do a quick mental audit of your own investments right now. Are you sitting on a massive pile of risky growth stocks with zero cash reserve? If so, you're playing a risky game with all strikers and literally no goalkeeper. A well-diversified global portfolio needs all 3/3 working together in harmony. You need that 20 to 30% cash reserve for opportunities. You need the passive income defenders for stability and cash flow. And you need the capital gains strikers to aggressively grow your wealth over time.
This entire framework structurally forces you to act like the smart money. It basically forces you to obey Warren Buffett's legendary rule: be fearful when others are greedy, be greedy when others are fearful. When the market is in a euphoric summer and everyone is being super greedy, your 3-bucket system tells you to trim your strikers and build up your cash goalkeeper. When the market is in a winter panic and everyone's terrified, your system tells you to deploy that cash and buy amazing assets at a deep, deep discount. So I'm going to leave you with this final critical thought. Take a hard look at your true diversification score across these 3 buckets. Could your portfolio survive a winter market crash if it happened today? Or would you be forced to sell your assets at a massive loss? By organizing your wealth into these 3 distinct jobs, cash, passive income, and capital gains, you don't just survive the winter, you use it to build real generational wealth. Thanks for joining me for this explainer, and keep architecting your wealth wisely. Catch you next time.